Hello and welcome. You tune into News Now with me, Ankita Saxena. Well, the bear grip tightened on the Wall Street as regulators flagged both froth building up in the broader markets. Nifty gave up the crucial 22,000 mark while Sensex ended over 900 points lower. The mid-caps came under heavy selling pressure, leading to the biggest intraday fall in 2 years. My colleague Ajay Sharma is joining us to take us through the factors which led to the sell-off.
Well, the carnage on Dalal Street continues. Specifically, the broader markets are under pressure. In fact, the small cap and mid cap part of the indices have come 5 to 6% away from their 200-day moving average, falling below the 50-day moving average. And we all know that for several months, strategists and fund managers had been calling the small cap, mid cap end of the market frothy. The valuations had gone above their own 5-year moving average. But in many cases, small cap, mid cap were actually trading above the valuation of their large cap peers. Several funds in the last few months and weeks have stopped taking fresh inflows in the small cap, mid cap funds, saying that only lump sum will be stopped, SIP flows will continue, and even the AMFI or even SEBI, the regulator, had asked for a stress test for mutual fund industry, especially looking at the big flows which are getting concentrated in the small cap, mid cap end of the market. So all of that is getting corrected now. We are seeing continuous fall happening in the small cap end of the market, mid cap end of the market, and in fact some of the regulators commenting about it, that there were some deviations and inappropriate kind of behavior happening in SME part of the market, small cap, mid cap. IPO subscriptions in the small cap, mid cap was seeing abnormally high subscriptions, some SMEs as well. All of that is getting corrected right now as we speak. In fact, it will be interesting to see the result of some of the AMC's stress test, which the AMFI and SEBI has asked them to see whether how healthy are the cash positions. If they want to, if some big redemptions come, can they furnish the big redemptions of the investors? That is a stress test they need to take. But taking a cue from all this, the small cap, mid cap end of the market is witnessing a big fall. Now, what should investors do? Long-term investors actually should not worry a whole lot, because they should either be buying in a systematic manner in a SIP format. They should not stop their SIPs at all, or if they have surplus funds, they should be looking at getting back into high quality names, even in the mid cap, small cap side. Of course, large cap is where the safety lies, in a phased, in a staggered manner. Traders should be light right now. They should not be approaching the market in a hurry and use up all your bullets in the market. But overall, structurally, there is nothing wrong. This is just a frothy end of the market which is getting corrected, triggered by some of the regulators' commentary or some other factors like valuations, etc. But the fact of the matter is that this is an ongoing correction. As an investor, you should be careful. No point acting in haste. This may continue some more time. There is also a March factor where loss harvesting happens by a lot of traders. In the next 15-20 days, things will be clearer. But long-term investors need not worry. Short-term investors need to be a little careful, because there is an outright kind of capitulation market we are in right now.
Well, clearly